in a way that will improve the balance sheets of all these institutions that own a lot of this debt, particularly the banks and funds and so on. And, I'll do the math here real quick, but just in the last 2 weeks, the impact on the 10-year Treasury has probably had a pretty sizable impact. We talk about unrealized losses. It's reduced those unrealized losses. It's improved them. So I think that's like the more important metric to be tracking is, if you look at all the assets that we're all worried about right now, are they going up in value or down in value in a way that introduces more stability into these kind of banking systems that we care about? And I think right now it looks like maybe things are improving. And that might be part of the optimism around, equity markets and folks buying and so on.
Yeah. And so this is, I guess, where people have started to talk about the next shoe to drop. We obviously had this time-based liquidity issues with Silicon Valley Bank. Now the Wall Street Journal is talking about commercial real estate and how much debt there is. Since COVID, obviously, people are doing more remote work. A lot of the skyscrapers, it's not just San Francisco, but in many locations, remain empty or underutilized. People are now having their leases come up. Every year, more and more of these leases will become vacant, and then we'll see if these buildings are worth what people paid for them. Smaller banks hold around $2.3 trillion in commercial and real estate debt, including rental apartment mortgages. Almost 80% of commercial mortgages are held by banks, according to this Wall Street Journal story. Sachs, you are an owner of some commercial real estate, and you play in the space. You have a lot of firsthand knowledge. What is your, putting aside your personal holdings or exposure, what is your take on what you're seeing? What is the game on the field right now in terms of commercial real estate in San Francisco and beyond?
Well, if you talk to the commercial real estate guys, they'll tell you that the situation is dire. There's two problems. First, there's a credit crunch going on. So there's just no credit available. If you're a commercial real estate developer and you have a building and you want to refinance your construction loan or put long-term debt on a building, you just can't do it. I mean, the banks are not open for business. They literally don't want the business. And I think that comes back to the fact that banks right now are hunkered down in a defensive posture. They're seeing deposits flee from their banks, unless, of course, you're one of the top four.
Does that freeze on the banks predate the Silicon Valley Bank crisis, and it was exacerbated? Were people having a hard time getting loans before that?
It predates it, but definitely what you saw with SVB and these other banks, including Credit Suisse, is that, banks now are getting much more paranoid. And that's why you saw that if you look at the discount window, which is when the banks go to the Fed as lender of last resorts and basically post collateral to get liquidity, we had the biggest spike in discount window borrowing since the 2008 financial crisis. Yeah, that line on the right side, that is a spike in 1 week's borrowing. This exceeds anything that happened in 2008. The warning sign should be flashing red over something like this. Now, to bring it back to
be clear, that's banks who have real estate exposure going to the Fed, going to the government saying, hey, can we get some money to cover these?
It's not specifically about real estate. It's more about bank liquidity. The banks are saying we don't have enough liquidity right now to cover our needs, which are highly volatile right now because basically depositors are moving out of community and regional and small banks into the big four so-called systemically important or SIB banks. So what's happening is that, again, banks are hunkering down. They're getting very defensive. They do not want to make new loans because they can't tie up assets. They are trying to stay liquid themselves. So that's what's happening now in sort of with respect to new lending. And then on the other side of it, you have existing loan portfolios. There's something like $20 trillion of commercial real estate debt. And most commercial real estate lending is done by small banks, by community banks. So they are sitting on these huge CRE loan portfolios. And I think something like 300 billion needs to be refinanced or is coming due in the next year. Normally that's rolled over and refinanced. There was a study showing that unrealized losses in these loan portfolios in the banking system may be around $2 trillion. It was a study that was reported on by the Wall Street Journal. So in the same way that we had huge unrealized losses in these long-dated bonds, I think we also have
at Silicon Valley Bank specifically. That's where
they were the worst offender, but it's a systemic problem. I think similarly, we have huge unrealized losses in commercial real estate loan portfolios. And this is, I think, even a more subtle and pernicious problem, because with securities like T-bills or mortgage bonds, it's very easy to know what the unrealized losses are. The reason why they hadn't realized the losses was not because they didn't know what they were. It was because of a stupid accounting rule that said they didn't have to realize the losses if they were quote unquote holding them to maturity. With these loan portfolios, we don't know how big the exposure is, and we won't know until you start seeing some defaults and repricings of assets. And
commercial real estate is a much more dynamic market, right? You have to have a buyer there. You have leases coming off at different times. You have subleases occurring, and you have the owners of them flipping them, right? And refinancing them constantly to buy new buildings. And so,
right. And those loans aren't as liquid, right? With a mortgage bond, those are basically a bunch of loans, home mortgages typically, that have been packaged up and turned into a security, and there's a liquid marketplace to trade them. In the case of these loan portfolios, there may not be a liquid marketplace, so you don't really know how impaired that loan portfolio is until you actually get to a place where.
When will we know? Because that's the thing I'm wondering. I saw a lot of headlines, Pinterest bought themselves out of their new headquarters in the Bay Area, San Francisco, I believe specifically. I heard Facebook got rid of a couple $1 billion and wrote down some expansion. Amazon is selling buildings. They had gotten a ton of buildings, and we saw last week they got rid of another 9,000, or they're planning another 9,000 in a RIF, and they can't get people to come back to the office. So right. How bad is the overbuild, I guess, is the question, because that will be the driver of the value of these buildings. Because if there's too much supply, then what are these buildings actually worth? Are they worth $90 a square foot? What if Amazon doesn't want more space?
You can see it in the credit default spreads of these banks. It's in the water table already. So Nick, you can just throw it up. If you look at any bank that's lending and that has a portfolio, this is Deutsche Bank's, euro denominated CDS, but it's the same for Barclays. It's the same for SocGen. It's the same for a bunch of American banks. There is a risk in the system that Sachs articulated that is now getting priced in. There are all kinds of loans whose payments, which the banks need, cannot necessarily be insured, which means that then there could be illiquidity there. There could be a flow of deposits out from those banks, which would then make their ability to pay their debt holders lower. You also have this complicated issue already where it's really like the first time in a long, long, long time where debt holders actually got wiped out in the Credit Suisse debacle before the equity holders did. And that's created all kinds of ripple effects. So this credit bubble is here, and it's being manifested right now in these very sophisticated